Thanks for tuning into Trade Talk. I'm Neeraj Shah, and a bit of buoyancy in the markets today. You have to take on board the point that there's been a fair degree of correction slash sideways movement in the markets the last few days, and Indian markets haven't quite reacted to the optimism of the global markets until recently, or rather until today. There is an upgrade from a global bank on India in their Asia ex Japan portfolio. Maybe that also helps. So we thought it best to get in somebody who's kind of great pulse on what the markets are doing and what they could do in the short to the medium to the long term. S. Hariharan, head of sales at institutional equities at MK Global, joins us right now on the show. Hari, good having you. Thanks for joining in. Hope all is well.
My pleasure.
So, Hari, what's the sense? I mean, a lot of people would today say that, hey, we told you that we were looking oversold. There's a bit of a bounce. Global markets are supportive. Is this something that you reckon could last? What is the screen telling you? What are you telling your clients, and what are your clients telling you?
Let me take a step back before answering the really short term aspect that you touched upon.
Mm-hmm.
I've been traveling in US and Asia meeting clients over the last month or so. And
Mm-hmm.
the feedback I got from them is kind of reflective also of what came out in a recent global FM survey by one of the big US banks, that India is a consensus underweight for most institutional investors, and it is currently funding a China overweight stance. So, which I guess also reflects in the net FII sell flow that we've seen this year. Right, year to date, where we've had about $3 to $4 billion of sell flow, and whatever outperformance Nifty had last year relative to MSCI EM, that has more or less got erased now. But all said, you're down only 5% YTD. It's not a very disturbing situation. The overall market itself has consolidated, I would say, over the last 18 months, because of which valuation, which looked extremely rich, both in a relative and absolute context, relative to other asset classes as well. For example, relative to bond yields, the earnings yield looked really low. So all of that has now come down from fairly elevated levels. So what it looks like is that it was a case of a lot of optimism, which is now kind of getting tempered. And on the other side, earnings estimates for FY24 for Nifty at around 950 rupees, they have literally not budged since June 22. So what was looking like 22 times earnings 1 year forward is now come down to 18 times earnings, which relative to Nifty history is pretty much around the median. It's not cheap. What has happened is, but that for the first time in 12 years now, we've not had any cut in earnings estimates despite starting from an elevated level. If you look at it from FY12 to FY20, Nifty earnings CAGR was something like about 3%. Every year there was some kind of one-off. But since 20, the streak, which was 20%, 25%, and now again for 24, it is looking like 16, 17%. And so far, there is no cut in estimates. So the market may not have become cheap. And in fact, the composition of earnings may also have undergone a change. But by and large, where we are, there's not a tremendous amount of downside. And to the extent that positioning is already extremely underweight, that kind of reflects the fact that people are right now waiting to see earnings surprises come back in before a next leg up starts. From a very tactical standpoint, also, if you look at it, foreigners, even in the index futures market, were holding a record short position in index futures until a few days back. I mean, that's probably eased a little bit running into the expiry, FNO expiry that happened day before yesterday. Nonetheless, the net positioning is still short. So,
Mm-hmm.
is there room to the upside in the very near term? I would bet that there is. But for the year, calendar year as a whole, I would say that the range of 16,500 to 18,500, which we believe is kind of fair, will continue to hold as the market adjusts to the composition of earnings changing. I mean, our view is that we might see upside surprises in financials, and we will see upside surprises potentially in materials, and potentially downside surprises in autos and telecoms. So at an aggregate level, Nifty earnings doesn't change, but the quality of earnings moves towards lower PE multiple sectors. And as a result, where valuations are at 18x, could there be slight bit of downside? Maybe there may be slight bit of downside, but earnings growth itself is not going to get materially impacted to the downside. If FY21 was a year of a valuation running ahead of earnings, this is a year where we believe that earnings are going to deliver upside surprises.
Uh, but that would be music to the ears, or an actually very pleasant, Hari, if indeed post the April earnings declaration, we do not see any kind of downsides to the 16, 17%. A few people have expressed skepticism. I'm hoping that that doesn't turn out to be true. So, Hari, it's a good point you raised. In the feedback that you would have received and in the thoughts that you would have expressed to your clients, are people waiting to, so for example, Morgan Stanley's today turned equal weight from underweight on India, right? My question is, are people waiting for a China uptick or some of the other Korea markets uptick for India's relative valuation to correct and therefore turn equal weight or overweight? Or are people waiting for earnings as the principal driver for changing their underweight stance on India? What have you learned?
See, what has changed since October of last year is, like you said, people have made a bet that there is going to be a meaningful recovery in China.
Hmm.
China faces its own structural issues in terms of stimulating growth and the quality of growth that they want to have going. As a result of which, what worked in the past may not necessarily play out in the possible revival, which
Right.
itself is a question mark. And the way that people think about Asia, Taiwan, and Korea are thought of largely as derivatives of the North Asia play. So you would have to put China, Korea, and Taiwan into a similar kind of bucket. And so the trade is already on. Now, whether the earnings that need to justify that trade will come or not, the jury is out on that. Whereas in India, the question mark is on a slowing consumer. Uh, India did not do any meaningful fiscal stimulus during COVID, and we do not see any evidence of a wage spiral. So, inflation is not necessarily a problem that India is going to have to face. To the extent that there is a tightening of credit conditions, yes, that will weigh on the consumer. The consumer has been weak, but there is no case for an asset impairment cycle, unlike what the developed world is looking at. So, if you
Sure.
look at it overall, the macro picture is one of fair degree of stability. And the industrial cycle itself is still in reasonably good shape. So
Got
just
it.
in the last 10 days, the defense sector, for example, has received about 50,000 crores of orders. The PLI beneficiaries, the capex cycle that they are going to engage in, that is still ahead of us. Cement and paints companies, the capex that they have announced, that is still ahead of us. So the industrial cycle for ahead for us seems reasonably good. The consumer is a weak point, but in a country with the demographic profile that we have, how long would you want to bet that it stays weak? Usually, it has historically not paid to bet against a weak consumer in an upcoming election year. Not that I believe that the government is doling out subs, but it has historically not played out that the consumer remains weak in an election year. So, if there is
Yeah.
going to be an earnings differential that plays out over the next 2, 3 quarters, obviously, I believe that earnings that come out in April, there may be some downside surprises, which was also the case in the January
Yeah.
earnings cycle. But is it material enough to dent estimates? And if you're delivering 16, 17% growth, how long can someone be underweight? India used to be 8% weight in EM 2.5 years back. That moved up to about 15%, currently at around 13% or so. But in the process of the weighting moving up, people were already synthetically somewhat underweight. Now they are actually underweight. How long
Yeah.
can you keep up an underweight stance in the face of growth?
Are your clients buying that argument?
So, I mean, people do believe that earnings estimates have not got cut. So, the bet is that estimates will have to get cut. Is that going to pan out? That is the question.
Got it. Okay. So let's see for the October, let's see for the Jan, Feb, March earnings season to try and figure that one out.
Yep.
Interesting. Two questions before we wrap. One, on a thing that you mentioned and one on a thing that you didn't mention. So on a thing that you mentioned, defense, large order flows, Now, skeptics always argue about looking at the past in defense for defense companies and how they've not lasted a whole cycle, only in fits and starts. Is this time looking different? Part one, Hari. And is a better way to play it via suppliers to defense, or are you guys at MK constructive on pure play defense companies themselves?
So we don't look at defense as a single sector. We look at it as an overall pack of industrials. And the way that we've been thinking about industrials is that last year it was the small lead cycle which played out well, which was Siemens and ABB and such like. And this year we are seeing slightly longer lead cycle plays which are beginning to come in, and DEL falls in that category, and that may further add into extremely longer cycle which may possibly be in the power sector. And so the whole pack, we believe there is meaningful amount of further order flows that will happen over the next few years. So where, yeah, you're right that defense in general has been in fits and starts, so one might question whether there is, but defense as percent of budget has also meaningfully come down. You have to understand that. And in the geopolitical environment that we are in, is there any downside to it? It is pretty much given that there isn't a downside to it. So you may end up in a situation where, with an increased, improved governance of PSUs, which are large in these defense sectors, I believe that you may actually end up in a very virtuous cycle for these companies.
Great. So, Hari, explain, if I take industrials and just extending your point, we have the MNCs, high quality ABBs of the world trading at 60, 65 times. And you mentioned BEL, which despite today's move and a large order inflow, is still fairly reasonable, right? And then there are companies in between. How are you playing this potential upcycle in industrials? What is, as a house, what are the top bets that you have? I mean, I'm not asking for a buy or sell recommendation, but just mentioning what is the research publication out there been?
So I'm not going to get into specific names, but what we are seeing is that suppliers into the power cycle, into this industrial capex cycle, so consumables, for example, in the capex cycle, are clear beneficiaries. These are people with high degree of visibility, and the valuation at this point of time looks somewhat rich, but that's in the context of flat earnings over a long period of time. And whereas now you have top line growth kicking in and margins beginning to come back simply because they have deleveraged their balance sheet. So all of these names, without getting into specific ones, we are getting quite bullish on, and materially from a 3-4 year standpoint.
Which is actually a key point too. My final question, information technology, what is your messaging? What is the feedback on either being constructive on IT or not being constructive on IT?
Look, our house view since October or November of last year is when the meaningful amount of probability of recession started getting baked in, and the prices were down about 40%. But our view is that our analysis over the last 3 cycles of developed market recessions suggests that IT companies improve their margins during recessions. They have multiple levers in terms of execution and entrenchment within clients, which allows them to expand margins. So our view is that potentially FY24, and what so far the evidence in the last 6 months in US at least seems to suggest that this might end up being a rolling recession rather than a single short recession, where you have small pockets of recession in different sectors at different points of time over an extended period of time, as elevated interest rates bite different sectors at different times, I suppose. So our view is that if that happens to be the case, then earnings will not get materially cut as opposed to downside surprise in revenues. So it may be that deal flow slows down a bit. It may be that revenue growth guidance also comes down a little bit, but margin expansion, which is already visible since the last quarter, will continue to play out. So we don't believe that, especially names, if you leave out TCS among the large caps, the others don't look extremely expensive at this point of time.
Got it. Very lovely talking to you. Thank you for taking the time out and speaking with us today. And all the best for a good earnings season, one where we hopefully don't see any evidence of the need to cut earnings dramatically. All fingers crossed for that. Thanks for joining in today.